Nvidia reported $81.6 billion in revenue on Wednesday, up 85% year over year, beating Wall Street's $78.9 billion estimate. And the stock fell. That is the surface fact. But the number that matters more than the earnings beat is 5.197%, the closing yield on the 30-year U.S. Treasury bond, its highest level in 19 years. These two numbers arrived in the same session, and they are not coincidences sitting side by side. They are in direct tension with each other. All three major U.S. indices powered higher on Wednesday. The Dow gained 1.3%, the Nasdaq 1.5%, the S&P 500 rose 1.1%. Oil fell more than 5%, as Trump said the U.S. was in the final stages of a deal with Iran. On the surface, this was a clean risk-on session. And inside that session, Nvidia delivered its cleanest quarter in years. Net income of $58.3 billion, adjusted earnings per share of $1.87, data center revenue surging 92% to $75.2 billion. CEO Jensen Huang declared that demand for Nvidia systems had gone parabolic. Nvidia also announced an $80 billion share buyback and guided second quarter revenue at approximately $91 billion, comfortably above expectations. The company lifted its quarterly dividend from 1 cent to 25 cents per share. This was not an ambiguous print. And yet Nvidia shares declined 1.1% in after-hours trading. The bond market was moving the same direction. Earlier on Tuesday, the 30-year Treasury had closed at 5.197%, its highest since 2007. The 10-year reached 4.687%. On Wednesday, yields pulled back modestly as the Iran peace signal emerged, but they did not retreat from the threshold that is now the market's structural reference point. That threshold is the reason Nvidia's earnings could not hold the bid.
For 18 quarters of the last 20, Nvidia has beaten Wall Street estimates. Each time, the question moved a step further out, not whether Nvidia is growing, but whether growth can accelerate from here. On Wednesday night, that question took on a new layer. The position pressure that moved first was not retail selling on the earnings miss. There was no miss. It was institutional duration management. With the 30-year Treasury above 5% for the third time in less than 3 years, the yield is now rich enough to pull capital out of equities that carry the heaviest valuation premium for future growth. Nvidia, with a price-to-earnings ratio that prices in sustained compounding far into the future, is exactly that asset. Bank of America's chief investment strategist, Michael Hartnett, has labeled the 5% level the bond market's Maginot Line. He has documented that Japanese government bonds rising 230 basis points in 1989, U.S. Treasuries climbing 260 basis points in 1999, and Chinese yields surging 150 basis points in 2007, each marked the end of a prior bull regime in risk assets. The historical parallel here is not that Nvidia is done. It is that when the long bond clears 5% and holds, prior growth regimes repriced. The mechanism is not exotic. Nvidia's biggest customers, Microsoft, Amazon, Meta, Google, are spending hundreds of billions on AI infrastructure. That spending is funded partly through debt. When the 30-year yield climbs, the cost of that debt climbs. The same inflation driving the bond sell-off, energy at 100 plus per barrel, CPI at 3.8% year over year, PPI at 6% annually, erodes the real terms value of those future infrastructure returns. Nvidia's revenue is today's recognition of yesterday's commitments. The bond market is pricing tomorrow's doubt about those commitments continuing. There is a second pressure point that analysts at Reuters and Devdiscourse have flagged this week. Kevin Warsh, the incoming Federal Reserve Chair, is a public opponent of quantitative easing. Warsh ostensibly resigned from the Fed board in 2011 over bond buying. He said at his confirmation hearing last month that he and the Treasury Secretary would need to find a way to reduce the Fed's $6.7 trillion balance sheet. That balance sheet, composed mostly of Treasury securities, has been the implicit safety net under long bonds since 2008. Remove the expectation of central bank intervention, and the long bond trades on its own fundamental supply-demand, which with $1.22 trillion in annual U.S. interest expense now exceeding 4% of GDP, is structurally bearish. Nvidia self-acknowledged the China absence in its current court outlook. Huang said the company had largely conceded the Chinese AI market to Huawei. China is not in the revenue guide. That is not a near-term revenue problem. Nvidia said global demand elsewhere was more than strong enough. But it is the first sign of an upper boundary on the addressable market that the prior thesis did not price.
The reversal condition here is specific. If the bond sell-off was purely an Iran war inflation story, a peace deal would collapse yields and unlock duration buyers back into NVDA. Trump on Wednesday called talks on the borderline. 26 ships transited the Strait of Hormuz in 24 hours. Oil fell back below $100 briefly. The 30-year retreated from its Tuesday peak. In that narrow window, Nvidia's after-hours decline could be argued as temporary. But Vail Hartman, U.S. rate strategist at BMO Capital Markets, said explicitly, people are not going to want to add duration risk until there's clarity around the Middle East. An analyst at BMO added that even a near-term end to the war may not bring energy prices down, meaning the inflation that pushed the long bond to 5.197% may persist past the geopolitical trigger that is blamed for it.
The unresolved question from Wednesday's session is not whether Nvidia's fundamentals are intact. They are. It is whether the bond market will allow the market to pay for those fundamentals at the multiples that were attached to them before the 30-year crossed 5%. Historically, the pattern is instructive and uncomfortable. When the 30-year Treasury cleared 5% in October 2023, the S&P 500 corrected 10% before Fed Chair Powell's pivot commentary in November reversed the move. When it touched 5% again in May 2025, stocks dipped but recovered as inflation expectations fell. On both occasions, the Fed's implied willingness to step in, to buy bonds if conditions deteriorated, anchored the recovery. Warsh has telegraphed that this anchor may not be available this time. The second variable is SpaceX. The S-1 filing on Wednesday disclosed $4.69 billion in Q1 revenue and a $1.94 billion operating loss, with Starlink the only profitable division at $1.19 billion operating income. The AI division, built on the XAI acquisition, generated $818 million in revenue against $2.47 billion in losses. SpaceX is targeting a NASDAQ listing under the ticker SPCX, with a roadshow beginning June 4 and pricing on June 11. At the reported $1.75 trillion target valuation, it would be the largest IPO in U.S. market history. The relevance to Nvidia is capital allocation, not competition. A $1.75 trillion IPO draws institutional allocation capital. Funds that are overweight Nvidia and underweight space infrastructure would face rebalancing pressure at SpaceX's pricing. That is not a short-term catalyst, but it is a participant timing asymmetry already visible in the filing. Large banks, Goldman Sachs, Morgan Stanley, Bank of America, Citigroup, JP Morgan, moved first, committing to the offering. Institutional equity funds have not yet repositioned. The leaning here tilts toward continued pressure on NVDA's multiple until one of two conditions clears. First condition, the 30-year Treasury falls back below 4.8% on credible Iran peace progress, reducing the discount rate applied to growth equities. Second condition, Nvidia's Q2 earnings in August deliver the $91 billion guide plus evidence that China's absence is offset by sovereign AI buildouts in the Middle East and Europe. Huang mentioned sovereign demand explicitly. Either condition would restore the bid. Neither is confirmed. The verification benchmark to watch is not Nvidia's next data point. It is the 30-year Treasury yield at the open on Monday, June 2, after the SpaceX roadshow begins and before the June Fed meeting. If the 30-year holds below 5% through that window, the post-earnings pressure on NVDA is likely mechanical and temporary. If it recrosses 5% while the SpaceX IPO absorbs institutional capital, the question is no longer about one earnings print. It becomes whether the AI infrastructure trade can hold its own cost of capital. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.